Ready? Good morning, ladies and gentlemen. We are the technology sector. First of all, thank you very much for being here today. I am Senior Analyst Irving Medina.
Senior Analyst Alex Trevino.
Alumno Junior Analyst.
Victor De La Garza, Junior Analyst.
Amber Ariad, Junior Analyst. Angela Venegas, Junior Analyst.
And Matt Blevins, Junior Analyst.
So let's go ahead and start the presentation. At the very inception of this venture, all we had at our disposal was the Russell 3000. We filtered everything down to reflect the technology sector and the 7 industries. Professor Sweet had actually advised us to separate the semiconductors and the non-semiconductors, since their valuation ratios are sometimes different for the ranking model. We were fortunate enough to have the manpower to assign each analyst an industry. So we have 7 analysts and we have 7 industries, which we will present shortly. But before we do that, we're going to go into the ranking model methodology. Alex is just going to do a quick overview. If you happen to have any questions about the actual model, we'll be more than happy to walk you through it after the presentation and after the discounted cash flow model.
Perfect. So as already mentioned, we start with the technology sector as a whole. And as we met through the weeks, we realized that there's distinct differences amongst technology companies. So we just decided to separate into 7 industries. So now feeling that we were at least comparing fruit to fruit, it wasn't exactly perfect, but companies were better matched. We also then we went on to look at the valuation and fundamental ratios to consider for the particular industries. So this is our breakdown. We looked at fundamentals,
Fundamentals as the profitability and risk.
Yeah, probability and risk, valuation ratios, and we actually considered every valuation ratio. So we don't just pick one. We will be able to reflect with you what the correlation was with every single one that is available. And then on the next slide. So another thing that we actually considered was we thought that our output would be affected by large cap companies and small cap companies. We realized that small cap stocks behave differently than large cap stocks. So that's another thing that we considered. And we also did analysis on ownership. So we wanted to see the buy-sell imbalance between institutional ownership to see that there are any signals there for our selection process. And next slide. So, sorry, go to just one. So this is kind of showing exactly what the process looked like, right? So we started with the technology sector, we broke it into the 7 industries, and then once we got there, we ran into issues with large cap stocks and small cap stocks. So then we even did another filter to take that into consideration. And again, it's not apples to apples, but at least it's fruit to fruit. And now I'll pass it on to Irving, who's going to go over the first industry software.
So I was in charge of the software industry. As you see, we have a ranking model chart above. The top 5 companies, according to our output, are up here, as you can see. Microsoft, EA for Electronic Arts, VMware, Intuit, and Semiconductor. Now, when we were analyzing each industry, each analyst was assigned to pick the top 2 companies within that industry so we can add to our shortlist. My top 2 companies were Electronic Arts, due to their consistent beating in earnings for over the past few years, and they're developing a lot of gaming software, and they're the next generation of gaming. Microsoft, Nadella, their CEO, has transformed the company. They're moving into the cloud computing segment, and it's producing a lot of revenues year over year. With that being said, we use the valuation ratio, the V to 12-month sales, with a correlation of 31%. And we're going to move on to the data processing industry with Alex.
Right, so back to me. So same methodology, again, what the ranking model did, it also filtered what metrics mattered most. So for example, if inventory was something that was not relevant, it just muted that entire column. So for data processing, my top 5 were MasterCard, Alliance Data, PayPal, Fiserv, and Total System Services. So Fiserv is a data processing company for the financial services sector, financial services industry, but my top 2 were MasterCard and ABS. And again, EV to 12-month sales is a repetitive theme because we really care, is your product selling? Are you able to generate sales with the software that you, or with what you're selling to your customers? And pass it on to Alan.
So as mentioned, I worked on the internet software and services industry, which this pretty much includes companies that serve as a platform to other consumers and also as a support mechanism for businesses to operate. And you can see here that our valuation ratio is also EV to 12-month sales with a strong correlation of 43%. And my top 5 companies, which were direct in the model, were Facebook, eBay, Zillow, LogMeIn, and Grub. And pretty much from these companies, my top 2 were eBay and Facebook. And pretty much my reasoning behind that was because these companies had great fundamentals, they had good valuation, and also they were projected for growth with some deals that I looked into. For example, Facebook with Sony, and also eBay with PayPal. So that's the reason why I chose those 2. That's my recommendation to the shortlist. And now I will give it to Victor with technology hardware.
So I was in charge of the technology hardware industry. The tech hardware industry is mainly the manufacturers of computer components and peripherals, included in phones, tablets, computers, and today even cars. So when analyzing the fundamentals, we found they had the highest correlation to Jason's peg, also known as the hybrid peg. This was a correlation of about 61%, which gave us the top 5 companies: Apple, Western Digital Corp, Hewlett-Packard, IPG, and CDW. Now, from the top 5 companies, we actually already own the top 2, and we were going to recommend a hold, but we talked about it and we thought about further diversifying our holdings in technology hardware. So I did further analysis of the following 3, and I recommended Hewlett-Packard and IPG Photonics for my shortlist. But next, I'm going to go ahead and pass it on to Amber with communications.
So I studied the communications industry, and what the communications industry is essentially the business of conveying information. Given our ranking model, we got the top 5 companies of Cisco, Juniper Networks, F5 Networks, Sienna Corporation, and Aris International. A few market leaders in this particular sector or industry are going to be Harris Corporation, which we currently hold, Motorola, and Cisco, but based on market cap alone. However, diving more into our model, the valuation metric that gave us the highest correlation of 59% is going to be EV to 12-month sales. I believe this was a good valuation metric because the top 2 companies that I chose, being Cisco and Juniper Networks, have a heavy reliance on sales for services, so I believe that was a good metric to use. Next, I'm going to pass it along to Angela with IT services.
Now, I have IT services descriptions up above. It's essentially a business that helps entities process information. One of the valuations that we used was EV to 12-month sales with a correlation of 50%. The same reason why for their services revenue growth. And also the key major players would be like IBM and Accenture. Although with our ranking model, we did come up with these top 5 companies. The top 2 that I chose were Cognizant Solutions and Square company. And I believe those were probably the best for our short list as well. So now I move on to...
Wait, sorry. So this was redundant to processing? Looks like a lot of the same companies?
Right. So what happened there is that when you look at IT services alone, they only had 25 companies. So we actually, to be able to filter more, we brought in data processing as well. Some of the data processing companies as well.
Okay, and you use the same metrics across those 2 subsegments?
Right. So they all fall under. So data processing actually falls under IT services.
Yeah.
So it's kind of like a recovering of IT services, but we wanted to look at data processing alone. So that was the separation there.
Okay.
Right, so I was responsible for the semiconductor industry. Now this industry can be defined as, this industry can be defined as any firm that designs, manufactures, or supplies semiconductors, which is going to be any chip that controls the flow of electricity on a circuit. Now, the main thing that drives growth in this industry is going to be heavy amounts of R&D and competition between the participants. And the major players are going to be Intel, Taiwan Semiconductor, Broadcom, Qualcomm, and NVIDIA. We used an EV to 12-month sales valuation with a 41% correlation to get our top 5, which was going to be NVIDIA, Broadcom, Applied Materials, Micron Technology, and Intel. Of those 5, we picked 2 as NVIDIA and Broadcom as our top 2. NVIDIA for their involvement in cryptocurrency and machine learning, and Broadcom for their excellent fundamentals, their explosive growth in the last 3 years, and their dividend yield. Now that's all for me. Next is our shortlist with Amber.
Right, so for our shortlist, it's going to be comprised of 14 companies. The way that we got these is every analyst was given an industry, and then from that they chose their top 2. The way that we got our final top 2 from these 14 companies was we all had a roundtable discussion. In that roundtable discussion, our top 3 metrics to look at were going to be if the company was a mature firm, overall financial data, as well as if they paid dividends or not. Given these 3 points into consideration, our top 2 ended up being Vigo, which is Broadcom, as well as Facebook. And before we go into the company that we selected, I'm going to pass it along to Angela, who will go over our current holdings.
Now, before we move on to our first selection, we wanted to show you our current portfolio holdings that we have. Right now, they are in a good standing. Each analyst did their own research on that industry, and we did. There was no red flags or anything, so we are recommending to hold as of right now. And now we move on to.
Yes, so selected company. From our short list, using the fundamentals Amber described previously, we selected Broadcom. Now, we all know Broadcom. They've been in the news quite a bit, but what exactly do they do? They design, develop, and manufacture digital and analog semiconductors worldwide. Now, they're actually a pretty mature company. They were founded in 1961. Their current CEO is Hock Hee Tan, and he's been with the company going on 10 years now. And they're actually one of the leading semiconductors in the world, semiconductor companies in the world. They have over 22,000 patents, and they're constantly growing through mergers and acquisitions, which we will discuss later. They've had constant revenue growth, achieving a record $17.7 billion in 2017, and we see a high probability of growth into the future as well. But next we're going to go ahead and talk about some of the products they offer, which, as you can see above, they include optical sensors, controllers, switches, and fiber optical items in the fiber optic area. Now, following me, we're going to go ahead and talk about some of the company history with Matt.
Right, so Broadcom, as we know it, has been formed over the years from a large amount of small mergers and a couple of large ones. But originally it was formed in 1961 as an HP Semiconductor division. They eventually branched off as their own in 1999 to form Agilent Technologies, who eventually was bought up by 2 other companies to form Avago in 2005. They went public in 2009, ended up buying LSI in 2013, and then Broadcom in 2015, where they then changed their name to Broadcom. Now that's it for a brief company history. Let's move on to the Porter 5 Horses analysis. Now, the threat of new entrants into this sector is relatively small, considering the high cost of capital required to start up a company there. The power of suppliers is also low. This is because the large amount of manufacturers based in China and in the industry, which does not give them a lot of negotiating power with deciding their prices. The power of buyers, however, is about moderate. This is because the economic moat for semiconductor manufacturers is going to be pretty narrow, considering they only really sell to manufacturers. The threat of substitution is also moderate. This is because of the heavy amounts of R&D and competition in the industry, the differences between similar products is not all that great. However, this is also mitigated by the fact that the steps in technology is not all that great, so there's that as well. The threat of competition, as I've said before, is high. This is because the large amount of R&D and competitiveness between participants to remain above the technology curve. So that's all for that. Let's move on to revenue segments by sector and geography. Their most profitable sector is going to be the wireless communication sector, 41% of the revenue. These are going to be chips in your phone that allows them to connect to cell phone towers and Wi-Fi. After that, we have wired infrastructure, 35%. These are going to be cable modems, wireless routers, and TV set-top boxes. After that, we have enterprise storage at 19% of revenue. These are going to be server components such as RAID cards, HDD, and SSD controllers. And finally, we have industrial and automotive and other at 5% of revenue. These are going to be chips and manufacturing robots and the computer in your car. Now, by geography, their biggest customer by far is going to be China at 54% of the revenue. After that, we got the United States at 7% of the revenue, Singapore and Malaysia at 2%, and the rest of the world at 37%. Now, this isn't a big surprise considering most of the electronic manufacturers are based in China. These are also going to be their biggest customers as well. Now, that's it for me. Next is Alondra with our financials.
So looking at Broadcom, we analyzed their financials based on 3 fundamentals, which were liquidity, solvency, and efficiency. Looking at their liquidity and solvency, you can tell by these ratios the numbers are relatively high. They're significantly high compared to this industry. So the one in darker blue, that's Broadcom, and in lighter blue, that's the industry comparables. And this is for the year 2017. And also, you can tell by liquidity and solvency ratios that Broadcom is able to pay its long-term and short-term debt. They're able to bring in enough revenue for that, and as well take up on a lot of more capital expenditures, which this is a great sign and indicator for growth. And asset turnover, that was the ratio looked over for efficiency. And as far as this goes, it's pretty much stable within the industry as well. And these are some additional information that I acquired through research was looking at their EPS was a great indicator, not only comparing it to companies in that same industry, but in other industries as well. Looking at Apple with an EPS of about $6 and Microsoft at $8. Broadcom had an EPS of about 18.51, I believe, for annually, and we thought that was a great indicator of the financial health of Broadcom. And that will be Amber with company risks.
Okay, so with all the upsides that we've mentioned so far, of course, we're going to have to dive a little bit into risks. We went ahead and split up the risk into systematic and unsystematic risk. First up on the board is going to be the fact that the semiconductor industry is very highly cyclical. A downside to the cyclicalness of the industry is Broadcom actually does not hedge against commodity prices. So any raw end materials that they have to buy, if there's a fluctuation in their prices, it can essentially slash their profit margins. Another risk is going to be the number of customers. So the top 5 aggregate end customers that Broadcom sells with is going to account for 40% of their sales. This does not leave Broadcom with much bargaining power, so if one of their top end customers were to ask for a discount, more than likely Broadcom would have to accommodate to them in fears of losing such a high percentage of their sales. Next, we're going to have their manufacturing. For the most part, Broadcom really does third-party manufacturing, so any issues that could happen with those manufacturing companies could snowball effect onto Broadcom. Next up, we're going to have their debt. While it's only $17.7 million in debt, it may not seem like a lot with a company that has such a large market cap as Broadcom. However, they do not hedge against interest rate risk, so this long-term debt could essentially be much greater than what they are leading off to be due to their ALM risk. On the systematic side, we're going to have tax changes. So recent tax changes after the Broadcom merger, Broadcom did a deferred tax liability on their balance sheets at a 35% marginal tax rate. However, with the recent tax change dropped down to 21%, they're going to let off. They're going to ease up on their long-term debt significantly. While that is a good thing, they are also being hit with a $1.3 to $2.5 billion repatriation tax. This will be a one-time fee that will get paid off over 8 years, starting in financial year 2018. However, as I mentioned earlier, since they do not hedge interest rate risk, this could essentially be a much greater issue than it's let off to be. And then lastly, we're going to have economic risk, and that is, as Matt had mentioned earlier, Broadcom does do a lot of their work outside of the United States, majorly in Asian countries such as China, Taiwan, South Korea, and Indonesia. So any geopolitical issues that are occurring could potentially affect Broadcom's profits. Next, I will pass it along to Angela with potential M&A.
Now, when it comes to M&A, we do know that Broadcom did fail their takeover for Qualcomm, but after that we started researching what companies could be of potential targets. And these were the companies that came up. First was Micron, Xilinx, and Mellanox. Based on their market cap, we actually do own Micron and Xilinx in our current portfolio holdings. So they are still good companies. The top company that we would think that Broadcom would be more interested in is Micron, just because of their market cap. Also, when it comes to potential growth, we We do know that they are relocating to the U.S., which potentially help them with their future M&A growth, with less regulations with trade and stuff. So when we also did hear there was about Intel buying out Broadcom, although we, through further research, we realized that it was only a rumor, and the CEO confirmed that it's not in their immediate interest to buy out Broadcom at this point. So when it comes to future revenue growth, we do know that they did close a deal with Broadcom Communication Systems, and that will give them an expected growth of about $5.5 billion. So that should be a good future growth for the company. And now we move on to macro with Alex.
So just to go quick, because I know we're going from the presentation, we talked about the big themes in technology on a macro scale, and we really focused on the ones mentioned here above. So really do think that intelligent apps, cloud computing, event processing. So now that systems are able to react when something happens and they don't really need people to go through an API and react to an event, so that's really powerful. Immersive experience, so that's anything with like augmented reality, virtual reality, or mixed reality, or like any mixed version of that. Blockchain, we think that distributed ledger with cryptography is actually really powerful for companies that trade at such high volumes. Security is going to be a big issue as we become more technology dependent. Digital representation, so that's anything that allows companies to take anything from the physical world and recreate it in the virtual world, and that way they can either go through training or work through physical assets at a lower cost. And then collaborative intelligence, that's just technology working together and just being more connected. We think that's also a very powerful theme in technology in the future. And this is just the chart of revenue spent, technology spending as a whole through different geographic regions around the world. We do believe that developing and emerging countries will also have benefit from technology spending. So.
Why is the date range like 10 to 12 years ago?
So it's 2006 to 2011.
What are you trying to show there?
We're just trying to show that there was obviously just large increase in technology spending overall around the world as technology just allows for streamline of different process like businesses. So we
maybe more powerful if you show current data.
Yeah, I think we can definitely pull that. We pulled that from Bloomberg's, which is weird. One of the functions.
Keep going.
Yeah.
Thank you.
Next slide.
So next, in the table above, we had various scenarios for the dividend discount model. We based these scenarios off of a best case and worst case scenario of the beta, ranging from 0.87 to 1 and then 1.25. We had the growth range from 3 to 5.5%. And then through this, we got a base case scenario range from $280 to $350, which is quite a bit more than the current stock is priced at. You might see some numbers that might seem extravagant, but actually these are relatively conservative estimates relative to other analysts. And you can also see from the graph, from the table above that the benefits outweigh the costs. Next, I'm going to go to Irving with the recommendation.
Wait, how did you come up with that growth rate range?
Well, excellent question, sir. So we come up with a long-term growth rate based on the historical economic GDP growth rate. So on a historical basis, the GDP grows from 3% to 5.5%.
So it has nothing to do with Avago or the underlying markets, but you took the overall U.S. economy, is that?
Yes, sir. Since for the we'll get to more into the DCF model. In terms of Avago, we use that same range for our terminal growth rate. I've seen in many models they actually use the GDP growth rate, historical rate, for the long-term growth rate. And we believe if it's relevant to AVGO, it's still relatively reasonable, as opposed to when you get into 6%, that seems a bit high. Did that answer your question?
Keep going.
So now we're going into the recommendation evaluation. This is the last slide for the PowerPoint, so thank you very much for your patience. So we're recommending a strong buy and a hold for a 1 year minimum. The current price as of yesterday's close was $237.12. Our target range based on dividend discount model and discounted cash flow model is from $280 to $400. And of course, we wanted to point out the annual dividend is $7 per share, or $1.75 per quarter. So now we'll go into the discounted cash flow model. We actually built this from scratch. All the formulas are tied in. I'm going to show you all the market assumptions and the debt and equity assumptions. Are you guys able to see that?
Just a little bit bigger, please.
Yes, ma'am.
Thank you.
Absolutely. Is that better?
Little.
A little bit? Let me do a
Sorry.
little more. Okay.
All right, that's great. Thank
Perfect.
you.
Yes, ma'am. So right down here, I'll go into our calculations for the unlevered cash flows. We also calculate levered cash flows, but we don't really use that for this model. So here you see the market assumptions, equity assumptions, debt assumptions, and firm assumptions. Here's some of the market assumptions. As mentioned earlier, we have the expected GDP growth. We normalize the risk-free rate to 3.5%. We can also, like I said, if we change it to 2%, which is the current treasury yield, it changes the intrinsic value for the perpetuity growth model and the exit multiple model. Let me reverse that because it also affects our WACC. And for the market risk premium, we use the implied approach. For the equity assumptions, we use our base case scenario of 1.3 according to the rolling beta that Amber performed, 3-year rolling beta. Calculate 10% cost of equity. And then these, the market value of equity and the market value of debt are fairly current as of Thursday, I believe. Oops, sorry about that. And then here we go into some firm assumptions. And then we calculate our WACC to 9.2%. Which is actually really close to what Bloomberg says. If you type in the WACC function on Bloomberg for AVGO, I believe it's actually 9.2% as well. So that we also have the long-term terminal growth rate, which is, we compared that with the expected GDP growth. So let me get into the revenue growth for the next couple of years. We have a 20% revenue expected growth rate in 2018. That seems a bit high, but as previously mentioned, they just finished their deal with Broadcom. So we expect to see some inflated revenue growth rate from there. And then from then on forward, it kind of dials down a little bit more. Back in looking forward at 2022, it goes down, of course, more. However, that's really contingent based on the M&A deals they choose to pursue, since a lot of their business model and business model growth is based on their mergers and acquisitions. So let me walk you through the calculations. Again, the revenue growth rate is all tied in. So let's say you wanted to change maybe for 2018, let's say it's 10%. Obviously, it affects all our assumptions. It affects our share price. And I can pull up Bloomberg's DCF, so I can show you guys exactly the radical difference between our DCF and Bloomberg's DCF.
If the company made no acquisitions, would it still be interesting to you?
That's a really excellent question. So we looked into that because I personally did not like the fact that they're relying on mergers and acquisitions to grow. I looked at a lot of articles and a lot of videos, including Hawk Tan's interview. That was one of the questions they asked. So they asked, well, what happens when your acquisition targets run out? Because there's only a limited amount. And he said, from there on, we'll focus on restructuring our model and perhaps investing some of the cash flows into research and development, which goes back to the whole Qualcomm deal. Cyphus blocked the deal based on that model that they're probably going to break down the assets of Qualcomm and it'll temper to the 5G market. So that's where Mr. Tan, he answered that question in an interview saying that we're looking to change our model. As opposed to doing more mergers and acquisitions, we're going to invest more in research and development. Yes, ma'am.
Speaking of research and development, did you find when you were doing the industry comps that the amount that a company invests in R&D is a factor in how their stock performs?
Yeah, we did look at R&D to sale, research and development expense to how much they're able to generate off the revenue. But we had to fact that obviously gets distorted with companies like Broadcom that do mergers. So we really, again, we don't want a Valiant type of scenario where they just go through M&A and then they look like they're growing at 500%, but they're really not. So we think that once they get to a good size, they'll be able to benefit from economies of scale and some of the efficiencies from being such a large company in the semiconductor space. I think that's what a lot of the companies are trying to do. They're trying to be big enough to where they can control a lot of the supply suppliers to the industry.
Not so big to their mouth.
And we'll show you the ranking model right after this.
So-
what we consider.
And with that being said, let me wrap up on the DCF really quick. Again, you can change the values, everything's tied in, but we also want to make it easier for you. We did a sensitivity analysis, which calculates the enterprise value and, of course, the value per share. Here's our base case scenario at 9.2% WACC and a perpetuity growth of a terminal growth rate of 3%. Let's say you wanted maybe a 2% growth rate, and let's say we kept that WACC, so the share price right now would be $361. Same thing using the exit multiple analysis. That our base case scenario was $290. Let me pull up really quick before we get into the ranking model, Bloomberg's DCF. Just to show you that we were trying to be really conservative with our valuation instead of just standing up here and telling you, oh, it's going to grow up to $1,000 per share. Bloomberg's analysis, according to the perpetuity growth model, was actually their base case scenario is $1,000 per share, and using the exit multiple method, is going to be at $545 per share. So that's pretty inflated. So we believe our assumptions were reasonable. Again, back to the range of 280 to 410. Now, without further ado, let's go ahead and jump into our ranking model with Alex.
So if I had to, so here's what we talked about. So when we first started, we were like only considering these metrics, and then we brought in more, a significant amount more. And the reason why is we want to capture just a little more information about the companies and make sure that we weren't leaving anything out or distorting our outputs. And so also what we did, so what you can do, we filter by the different industries. And we also did a historical analysis, so we actually went back to 2010 and ran the ranking model to see what it looked like every single year, and found that there wasn't a whole lot of movement, but companies did stay with, relatively within the range we got. So sorry, this thing is massive. Hit some cells. Okay. Right, so we pull in the Bloomberg data here. We did some macros because working through this just took too long eventually. So it automatically pastes the values in here. It'll filter any errors down here. And then what's really interesting that we looked at is, so in this case, if it's highlighted, I'll zoom in a little more. So we can actually see how the companies rank. For example, Intel is the number one on profit margin. So we see where the companies rank on fundamentals for each particular metric. And then this is the risk. And now highlighted in green will be your top 5 based off, again, the fundamental analysis. And we ran solver to get the highest correlation. And then here, you're going to actually see the different correlations for every single valuation ratio. Sorry, try to zoom in and go across. So how they rank fundamentally, and here's the divide, this line right here, it's where we divided between large cap and small cap stocks. So up here, the ones that are being considered for large cap. So this is, right, so an EV to EBITDA, price of sales, EV to EBITDA, EV to 12 month sales, and some of them are pretty similar. So for example, market cap to revenue is going to be pretty close to EV to 12 month sales. There's just a little distortion, but they're like almost like perfectly correlated just because. And then over here, finally, so if you're getting green, that means that there is a big difference between the fundamental and then the valuation metric, which means that it's trading cheap. And if it's in the middle, it's moderate. If it's red, that means it's a rich stock. It's trading expensive. And again, we have it for we did this for every industry. And again, ran solver. And we were kind of upset because when we always start, we want a high correlation. We were like getting like lost in it, but honestly, this is as high correlation as we can give to evaluation ratio. So we just had to do more qualitative research to really pick our companies at the end of the day.
Did you dismiss metrics where the correlations were low?
So
Like a 1%
we didn't want
correlation
to.
is not.
So at the end of the day, like this is what it is. Like this is what it ranks fundamentally to price to free cash flow. So even if it's a 6% correlation, if you're considering that as your valuation metric, the differences between those is what you would expect. So we just wanted to see horizontally across like what the differences were for different valuation ratios.
It's not included in your score if it's a.
Right. So in our score, we showed you the one with the highest correlation, right? But we also looked horizontally on how they ranked on different valuation. But we thought that's where we factored in what fits best with this particular industry. Are they focusing on sales? Are they focusing? That's kind of our reasoning behind that.
What does it mean to you that across all the different subsegments that EV to trailing revenues was your primary indicator? What was the meaning of that?
So EV to trailing revenues is that they're looking at how much a company was able to sell within the last year. And again, this is the stock screening model really served as just to get us started. Like that's what really we didn't like go fully based on just the ranking model output. Because if you see, we actually some of the stocks that came out shortly rich, we recommended because we thought that actually they were quality security. But again, this served as really just a filter for us to really see where the playing field was. And then from there, make an informed decision after we made research on the companies that came up on top. Like I said, we started. So here's where I said. So we filtered. So if you look at information technology and IT services. So I think this is a conversation we had previously that if we did data processing, so here's data processing, did a good amount of stocks. If we only ran IT service consulting, like we only had 25 companies, so that's the reason between factoring more companies under the whole industry of IT services. But I mean, what's nice is you can actually run like any sector through this model. And it would just, again, they're screening models, so we didn't solely depend on it, but it did give us a lot of valuable information for us to do further research and make an informed decision on which companies we think were doing best in that particular industry. Did you all have any questions? I know, yes.
I have two questions.
Sure.
I think you said the fair value was between 280 and 400 or so.
Sure.
So at what point in that range would you recommend a sale?
That's an excellent question, ma'am. So we also we try to do most of our research organically, between us, and we try not to rely too much on analyst estimates. However, we still did do some research on equity research reports and some of the analyst recommendations. A lot of the target range for the analysts for the share price for the 1 year, which is why we recommended for a 1 year minimum, was between 305 to 322. So a good sell would be, just to kind of hedge your risk, I'd probably say like around 300. I actually held some personal shares from them as well. Right now they're at 237. They recently announced some buyback. So I mean, companies do that when they feel their shares are being undervalued, and they really are based on a lot of the information we're looking at.
But you also at one point to sell, right? So what we really did want to consider option strategy for this, but our portfolio just can't handle that because we don't have that many shares. So whatever you feel based on the output that we got, like what level you would take your loss at, that's kind of like a recommendation. So if the share price is at 237 and you want to, you can't take loss if it goes down to 180, then you put a protective put to kind of like minimize that loss if the option prices are attractive at the moment.
I really like that you broke yourself up by industry because that's what institutional sales shops do, from my experience. But I'm wondering, if you take a step back and you look at the forest, what are your thoughts on the tech sector in general? Because it's bigger than the 6 smallest sectors put together right now.
We have a chart. So we looked at a chart. We actually on top of this we were able to see how the tech sector was trading. Again, all those same valuation ratios that we looked at. So like for P, for example, like is tech trading extraordinarily high? It's ticked up, but it's been nowhere near the level it was at 2001. So we didn't really see any signals of worry at the moment. But tech is, people love it. Like people are getting into tech. People are buying all the tech ETFs. And that was also another reason why we that's another reason why we feel that large cap companies are going to perform better than small cap at the moment, because there's such a high influx into index stocks, funds, particularly for like the big top tech companies right at the top. So we did see a trend in there as well.
They can always acquire the smaller companies as well. So as they grow bigger and bigger, not to the extent of a monopoly, but a lot of these major players are going to take the majority of the market share. So companies like for semiconductors, like Broadcom, we expect them to kind of just be the bigger fish in the pool. So
yeah, and there's definitely so for small cap, you literally have to find which small cap stock is going to be bought out. Otherwise, you're looking at a full loss because they're going to go out of business if they're not acquired. We believe that that's going to be a trend. Of course, if there's no intervening from the government. But yeah.
it's fine.
So did you guys determine, it looked like you had a big discrepancy, like you said, between the Bloomberg DCF model and your DCF model. What factors or assumptions were driving that difference?
That's another excellent question. Thank you, ma'am, for that. So we looked at the Bloomberg's DCF, and first thing I noticed is that they're actually doing non-GAAP measures here. For our DCF, let me pull that up real quick. We pull everything from the Bloomberg, the GAAP, and also cross-references with our 10K to make sure every single number was correct. So we had our income statement, balance sheet, statement of cash flows. So that was our first discrepancy that we noticed. Also, their WACC was it got a bit higher. I changed it here, but it was at between 11 and 12%, so that kind of inflated their shares as well.
Which is better, GAAP or non-GAAP?
We preferred GAAP.
Why?
Just when it comes to, since they're re-domiciling to the U.S., we figured that kind of allows more transparency. So we just prefer GAAP.
No.
Thank you, ma'am. Was there any more questions?
Because the weighted average cost of capital and then the fact that they're using non-GAAP.
Yeah, and again,
They really inflated their cash flows as well. Their free cash flows were up to $20,000. In our model, I think the highest they went to is $13,000 or 13.
what some of the Bloomberg
Million.
templates do, they'll take the historical averages, for example. So and Broadcom went through a merger in 2014. So it's not going to grow, revenue growth is not going to be 30% for the next 5 years.
So we couldn't use a CAGR.
Right. So when they factor in some of that, that's where their estimates just get shot up. So we had to actually reason what realistic growths and changes were. We didn't want to just pull a 5-year average from the past 5 years. We actually looked at the industry and see what was actually possible for Broadcom.
Thank you. And I know we covered a lot, threw a lot of information at you, but hopefully we were able to answer all your questions. Was there anything else you had for us today? Because I know we're taking up some of the time for the sector and for you as well.
All right. Thank
you.
Thank you.
Thank you very much.